Welcome to the Winning Wealth Podcast, episode 2, and we are fired up for today. Today we're going to be talking about the 5 reasons that we love real estate as the best investment option to grow your wealth over time. And we're back, episode 2. How you doing?
Good. Ready to kick this one off.
You looking good? Got the buttons down? Feeling it, man. I'm feeling
Ready to go.
Yeah, let's do it, man. So today we're going to be talking about why real estate specifically as a means to creating wealth. A lot of times I tell people it's literally engineering wealth. And we'll get into why I think that is. But we've both looked at numerous different business models, whether that's starting different companies in different industries, buying companies. And it seems like, at least for me personally, I'm always kind of dragged back to like, what am I doing? I might as well just focus on real estate. And so we'll get into the reasons why today, but
yeah, I mean, I think it's the same for me. It's like when you kind of started and wanted to take an entrepreneurship path, you look at all these different ways to be an entrepreneur, right? To create wealth. And there's so many different ways to do it. And I think I started like trying to create like some products, right? Like come up with an invention, right? You watch Shark Tank and you get all excited to go create a product.
Yeah.
And there's certainly ways to do that. But I think for me, it was like, I knew I was going to come up with some sort of crazy product that no one's ever heard of. And I figured, hey, like real estate's a proven way to create wealth. Pretty easy path forward with it. Why not just do something that's worked for, hundreds of years? So that's really why I kind of got into real estate after trying a few different things and worked out, right?
Totally agree. I'm just like, look, I'm not going to create the next crazy awesome app. I think I'm somewhat creative, but not that creative. And also, I'm myopically focused on the return on time. Everything that I'm doing, I'm trying to make sure that I'm either having a damn good time and doing it if I'm wasting some time, or I'm getting a return. I'm getting some value back for what I'm doing, and I can't see myself tinkering in a garage and trying to create some next crazy awesome invention and then have it not work out and have it be a huge waste of time. So I guess
even like software and like apps and that sort of thing. Like,
and
you put thousands of hours into creating this product, and you bring it out to market, and it's just like nothing, right? It's like, okay, now we got to start over again.
All that time wasted versus like, hey, I just bought a building, we just paid down.
It's cash flowing, I'm making money off of it. Let's do the next one. Yeah.
And we'll get into the reasons why, but real quick, now that before I forget, you had told me about an idea that you had one time that I think was picked up on Shark Tank. Not by you, but someone else had the idea, same idea. What was that again?
There was, I think I was like a sophomore or junior in college, and I was watching Shark Tank, getting amped up, like, what am I going to do? And the idea was pretty much a swimsuit for dogs.
Okay.
So it started as like, growing up, we had a pool, right? And like we had a dog, and the dog could never go in the pool because like the hair would come off the dog and like clog the filter up. So my dad always like shut that down, like no dog in the pool. Although the dog like is the favorite thing, loved to swim. So I think it was like me and my mom actually came up with it, where it was like, a dog suit for a dog so the hair doesn't get off the dog going to the pool. So then I was like, we started trying to figure it out. And, like I think my mom was like sewing some shit together, and like I was doing some research on it. And then like really just tried to figure out how to all do it. And like I was trying to look at patents and stuff, and like there's just way too much going on. And ultimately never really fully went through with it. Ended up getting picked up on Shark Tank like the year after or something. But looking back on it, it wasn't like, now that I think about it, like, okay, maybe if I would have pursued that, like could have created a little business out of it. But that's not something you're going to scale into like $1 billion empire, right? Like dog swimsuits. Maybe there's a way to branch off of it, but.
And we'll get into that. We got together last night and really hammered out the 5 main reasons that we both gravitate towards real estate. And, but so a lot of these different businesses, they're great, they're fun. I was going to do in college, I was going to like help people out in Waukesha where there's not, where they have water softeners. I was going to haul like salt, like water softener salt. And I just realized I'm like, I think I could have built a little college business out of it, but it was just like not super scalable, right? I know that is a business. I think there's a couple of small businesses like that are doing that. And there's been a number of different ideas. I almost started a sales and marketing consulting agency. I did some kind of side work for different startups like that, and I'm like, man. And now, and we'll talk about it later too. Now the different things that I've looked at investing in, and companies potentially to buy, and I'm like, man, everything real estate is just. I'm a simple guy, right? Mm. And so with that, these are 5 simple reasons why we believe, investing in real estate is it's been proven to be, the best path towards wealth. And this winning wealth brand that we're starting is all about how do we help people grow their wealth? How do we grow our wealth, right? And grow from, a small baby amount of money to, multiplying that. And I've always said it's these 5 reasons are why I believe if you can build a real estate investment company, it's like engineering wealth. Mm-hmm. And so you want to kick it off with number 1?
Yeah, number 1 is protecting capital, right? A safe investment, store of value. If you look at having money in the bank right now, right? Like right now is a little bit different. Inflation's higher. You're getting a couple percent from the bank, but historically, like you're getting 0.0 something percent from the bank. Whereas in real estate, it's constantly growing, right? It's a store of value, safe investment. Look back at, the past 100 years. What are the investments that were the safest, right?
Yeah.
It wasn't investing in tech companies. You got bonds, right? You got stocks that are going all over the place. But real estate's a historically proven asset that's going to continue to grow over time.
It goes up and to the right. Real estate values. Against inflation, it's a great hedge against inflation. I realized it when I was a dumbass. Started making solid commission checks in my early 20s, and I just realized pretty quickly that you make 20 grand at 23 years old, and if you don't have something to either just a ton of discipline and you go set that money aside in a savings account, which again you're losing against inflation. If you have too much cash sitting around, but I realized that I would spend it a lot easier. And so that was the first time I was like, I'm going to take this commission check. I can't even remember how much it was, but I'm just going to take that. I had my kind of operating expenses, figured out in another account. And then I'm going to take that commission check and just go buy a duplex. And I can't even remember what the return on investment would have been, but it would have been a shit ton. And so, number 1, protect capital. I couldn't agree with you more there.
Absolutely.
Second reason, and we'll talk about this a lot on this show, but is cash flow. Some of our favorite people talk about cash flow. Grant Cardone, Kevin O'Leary says cash flow, and I love that. And it really is. It's the lifeblood of any business, really. Predictable, dependable cash flow. Reliable, predictable cash flow is what drives values. And so if you know that you have solid cash flow over and above your expenses and over and above your debt amount, you can weather, really any storms. So it's if you're doing this as a passive investor, that, hey, your money is hopefully in a good asset, being protected, like rule number 1, and then that's also generating, monthly or quarterly checks, mailbox money.
And I think also, something that I know we tend to live by too is just cash flow kind of provides that equity or that money to live off of, right? It's generally more of a passive number that's coming in each month. And if you build it as to where, you have all the other things going on that we're going to talk about, right? The different forms that create wealth through real estate, but cash flow being the main one. Whereas if you have, you build up a certain amount of properties that's bringing in, $5,000, $6,000, $7,000 a month in cash flow coming in each month, that covers your living expenses, right? It's a way to create the passive income lifestyle, right? Financial freedom is really where cash flow drives everything too.
Yeah, we're gonna come back to that because I do want to touch on that. But it's the whole goal, when you're creating wealth, is to not spend the principal, right? Let the principal, the equity, continue to grow and build, and that takes us to the next one, which is appreciation. Tell us a little bit more about real estate appreciation.
There's a lot of different. There's a few different forms of appreciation, right? The first is, the tenant paying down your mortgage, right? So I think for me, the first deal I did, duplex, I remember the first month I was in there, right? I looked at, okay, I was living in one of the units. I actually had some roommates, rented out the top unit.
House hacking.
And the house hacking model, yeah. So I looked at the end of my first month, right? I think I was like positive $500 a month in cash flow. So I was like, all right, sweet. That goes into the bank account. Then I looked at my mortgage statement, paid down, it wasn't a big number, a couple $100 in the first month, and on my debt. So that's coming down, right? It's like, okay, there's other forms too that we're going to talk about here, but that's the first one where it's like you look at your tenants are paying down your debt. So as the years go on, right, you continue to pay down your debt, you gain more equity in that property just from your tenants paying it down.
Yeah, there's a great book by Gary Keller called The Millionaire Real Estate Investor, and he's got 2 infographics in that book. Maybe we can throw it up, figure out some way to do that. But essentially, it just shows over time your principal pay down increases and the rents increase as well. So it's a widening gap of, not only is the property becoming more valuable, your equity in the property is growing over time, you're paying less and less interest, and your top line revenue, your rental rates are increasing over time. If everybody knows that rent is going to be more expensive in 3 years, 5 years, 10 years than it is today for renters, and so it's a widening gap over time. And so the other thing, and there's natural appreciation. I think you started to talk about this a little bit. There's natural appreciation where it's just asset values go up, right? And that's the hedge against inflation part. If you pick the right market, like an emerging market, where you're starting to see, and if you're early into that market, you can really get a lot of appreciation just by everything else becoming nicer around that area, right?
Natural market appreciation. Yeah, if you look at markets like, it happens more so in a lot of the southern states, right? Like Texas and Florida, where, mass population growth, mass job growth, all that stuff drives the natural appreciation. And that's just, you're not doing anything, right? Yeah. You're just sitting back and watching the market go up. It doesn't always go up, right? It could go up, could go down, but over the long period of time, it's gonna trickle upwards. There's certainly markets like for us here in the Milwaukee market that we're investing in. It's not a huge natural appreciation market, right? We still benefit from that a little bit, but we're more so on the cash flow side here. We're heavy cash flow. We're going to see some natural market appreciation, but there's certain, like you said, there's certain markets that could be more of the play. And you don't want to bank on. For us, we're not banking on natural appreciation because it also could go down for 3 years straight, right? But over the long haul, it's another form of increasing your property value.
Yeah, what you're talking about is in the Midwest, particularly Milwaukee. Other Ohio has Cleveland is another great. They're linear markets, right, where you're not going to go up and down as much, right? It's kind of just going to be slow and steady cash flow markets, and that's why we like it. But I will say this too: you can, and in one of our next episodes, I'll talk about this a little bit, where I was trying to find some emerging markets within our greater kind of southeastern Wisconsin area, which is not a huge market appreciation or a natural appreciation market. And what I mean by that is like I bought a 34 unit apartment building in Racine, right? And I was like, man, I can just feel the trend is changing. Like Kenosha was already popping. This is kind of that bridge between Kenosha and then Milwaukee and the suburbs there. And then Foxconn was coming in, and I'm like, I'm a genius. And you'll hear me say that a lot because I tend to think I am. It doesn't always turn out to be that way. But it's been a great deal for us. There was truly a lot of appreciation, and the market was getting better and better with a lot of different projects in Racine. If Foxconn would have came into that market, it would have just absolutely killed it even more. I think Microsoft's building a data center there now too, so still might. The property what we did right there was we bought for cash flow. And so if you do that in an area that you think can get some, that things are improving, you can really, juice your investment on both sides. And the last thing, other than natural appreciation, is forced appreciation.
Yeah.
I want to talk through value add, forced appreciation.
And that's what we do is value add strategy, right? Forcing appreciation is adding value to the property. So in the commercial space, and even residential too, is most of it's tied to the net operating income, right? So if you can add $1 in the net operating income, that's going to increase the value of the property. So, for example, right, like if you can add $100, increase rents by $100 a month at an apartment building, that equates to $1,200 a month and more income coming in.
Yep.
There's certain ways to evaluate what that adds to the property, but roughly speaking, that could add $15,000 to the property value.
Yeah.
So you look at each dollar and putting that in your bottom line, it adds to the property value.
Yeah.
So you come in, increase rents, lower your expenses, maybe you add some parking income. There's hundreds of ways to add value to these properties, but it's all forced appreciation that at the end of the day increases the property value,
Yep.
increases your equity in the property.
So back to that 34 unit in Racine, right? We liked the market. We thought that it was improving. I still like that area. Like I said, if that Microsoft data center comes in there, I'm going to be all over it. The Racine Harbor and Marina area was getting a lot nicer. There's a $50 million development that was going up just down a few blocks away from us. So that was just going to improve kind of the area in general. But what we did is we took all the cash flow. This was a joint venture. This was not a syndication. We didn't have investors. And we basically took all the cash flow and put it towards turning the units. And so over the first year, we didn't really see any cash flow. We didn't need it. That wasn't kind of the business plan at all. But we took every dime and invested it back into the property to, clean up each of the units, make them a lot nicer. And we got $200 on average, $200 per month per unit more. I mean, do the math. It's like $400,000 in value, but hit it with an 8 cap.
So yeah, if you added $81,000 in income for the year, and divided by an 8 cap, that's $1 million in value.
Okay, maybe I'm a little bit high, but it was like 150. I tend to exaggerate sometimes. I'll say that it was a ton of value, great deal, and so that is the difference between appreciation, natural market appreciation, forced appreciation, value add strategies. What's the fourth one?
Tax benefits.
Everybody talks about it.
This is a huge one. I mean, if you look at most of the very wealthy people, or not most, but a lot of them invest solely in real estate because of the tax benefits.
Yep.
And everything you can do there. I mean, there's so many ways to legally, right, avoid tax bills in real estate, and it's an asset class that, if you look at as far as tax benefits, there's no other asset class out there that has the benefits that real estate does.
Yeah, I never claimed to be an expert at the tax code. I think every time I do my taxes, I have to call Megan, our accountant, and really just go through everything with a fine-tooth comb and make sure that I'm understanding it. I don't always quite understand everything, but I do know that it is either there's a great podcast, I think it's called Real Estate Tax Strategies or something simple like that. But, it's either the most tax advantageous asset that you can invest in. And if not, it's, sometimes there's things out there like EV cars and different things that they're promoting, for a lot of tax incentives for that given time. But over time, real estate has always been a very advantageous place from a tax perspective. We have investors that literally just invest in our real estate deals for the tax advantages, right? And so the first one is depreciation and accelerating that depreciation. These buildings allow you to depreciate certain things around the building and use those as write-offs. So the property can cash flow a ton, but you can do what's called a cost segregation study to basically take inventory of all the depreciable, I don't even know if that's a word really, but the depreciating parts of the building that and then accelerate that forward so that you can take more and more write-offs, which really makes it so that cash flow, many times the cash flow is like after-tax dollars. So you work on getting number one, the cash, or no, that was the number two actually, getting the cash flow up. That is that's basically after-tax dollars that you can go spend, and you're not having to worry about I still have to pay 30-40% in taxes on that.
Well, yeah, you look at your tax return a lot of years and it's negative. and you're like, well, I know I had money coming to my bank account. My tax return says it's negative. It's because accelerated depreciation.
That's the whole goal. That's why so many people get upset. Particularly, Trump was a big one where everybody hated that he wasn't paying. He didn't want to release his tax statement.
Depreciation. It's totally legal.
It's totally legal, and it's the reason he didn't want to release any of that stuff is because most people don't take the time to really figure that out, and they're like, oh my God, those landlords and those business people they're cheating, and that's not the case, really. They're paying a lot of taxes in a lot of other areas, sales tax, property tax, things like that, right? They're stimulating the economy with a lot of jobs. They're improving the neighborhoods. But yeah, if you can, the name of the game is to try to get it so that on your tax return, it says you made $0, and through owning real estate is a great way to do that.
Yeah, you got things like 1031s too, where it's like if you sell a property and buy another property, you don't pay taxes if you do it in a certain amount of time frame. So I mean, there's so many loopholes in the tax system that benefit real estate. I know there's a lot of discussion recently, right, about trying to cut some of these things, but I think it's it's not going to get cut just because there's so much necessity for it.
So many of the people that are voting on that own a lot of real estate too, right? Yeah. And the 1031 exchange, being able to move the equity from the sale of an asset and not pay capital gains tax on that, if you exchange that into what it's called a Starker exchange into another property, a qualifying property, you're essentially just avoiding paying taxes on that. And guess what? The next property you buy is probably going to be bigger. It's probably going to cash flow even more, and you just continue to step up with these properties. So tax benefits is huge. I would say anybody that has a sizable income outside of real estate, even if they just want to passively invest, it makes a lot of sense to consider real estate investing. Even if you're like, look, I'm not as concerned about the additional cash flow, although I would tell you that nobody hates getting mailbox money. But really, it can, obviously I'm not an accountant at all, I'm making up words here, but I would tell you to get some advice, get with your accountant, figure out if it makes sense to explore some of the tax benefits of investing in real estate.
For sure. Fifth one, scalability.
Yeah.
Growing. I mean, the ability to go big, right? I think we're talking in the beginning about like certain businesses. There's a cap, right, on how big you can go. Real estate, there's so many ways to get creative and leverage debt to grow the business. So I think that's the fifth reason is scalability.
100%. You can grow it as big as you want. That's what I think about a lot right now is, okay, so I'm 33, I'll be 34 in a couple months, right? Real estate's a business that I can do the rest of my life. And I fully intend to be in this game for, the next 30, 40, 50 years. I was reading about Sam Zell recently. I mean, he said he's going to do deals till the day he dies. And I feel the same way about that. I love doing deals. You can set up systems that are scalable, that you don't actually necessarily, like your time is decoupled from your income, right? So if you have the right systems in place that are scalable, which is a lot of stuff that we work on at the point of our business that we're in, and that's why I think this podcast and this Winning Wealth, brand that we're going to be, starting here is so exciting because we're at a point where we're not like overly far down the road. We're really, we're a few years into this. We have, the business off the ground, generating a lot of net operating income and cash flow and buying some great assets. But we're at a point where we're really trying to figure out how do we systematize, how do we make this more scalable so that we can grow, and it doesn't necessarily if, as we were talking about other business models before, I mean, if you're doing consulting, right? Your time is directly tied to the amount of income that you can make. Now, you can do things that would improve your billable rate, your hourly rate, but no matter what, you can't completely decouple your time from the income that you have. And in real estate, you can pretty much do that by hiring people underneath you, and having the right systems in place.
Well, also the ability to get debt. I mean, you can, banks are going to leverage 75, 80% of the loan. Look at other asset classes, right? So real estate, right? If you have to buy the right property, right, and there's certain requirements, but bank will give you 75% of the money to go out and buy that property.
Yeah. Now we're recording this on May 1st.
It's tough. There's some things in the banking world going on right now.
Yeah, the banking world's kind of crazy. We got another bank failed over the weekend. But that being said, it's still real estate is still going to be one of the most, if not the most, lendable assets that there is.
Well, yeah. Go try to walk into a bank and say,
walk into Chase.
You want to buy? Yeah, walk into Chase. Say, I want to buy. $100,000 worth of your stock. Can you borrow me 75% of that? They're not going to borrow it to you. Or go in there and say, I'm trying to buy some Bitcoin. Can you give me 75% of the money?
Yeah.
No. Or even you start some sort of business, right? Mm-hmm. You want 75% of the money to start it. They might give you 50%. They're not giving you 75%.
Yeah.
Real estate's one of the only asset classes where they're going to give you that high leverage because there's so much confidence in all these reasons we're talking about to be a great asset.
Yeah. The way to look at that too is, as I said about scalability, building out teams and systems and partners. Like we talk a lot about partnering together. I think both you and I, just meeting each other and figuring out that we have different skill sets and partnering together is a great way to leverage your own time and grow your business. But I look at the banks as a partner, and if there's multiple banks competing for our deals, right, they're going to give us better terms. So even real estate's better than other asset classes if you can find these bank partnerships that believe in the deal, believe in us as operators. They'll give you you can get really great terms even in a market like today, and we're still buying. We plan to buy the whole way through whatever's coming, and make sure that we have the right debt to go with the right deal so that we have the scalability to continue to grow this portfolio.
I would say on scalability too, right? Like we said, there's no cap on how big you can go, and some people might be thinking like, well, yeah, there is because I only have $50,000 on my bank account, and I can't go bigger than that. There's ways to get creative in real estate, right? Like joint ventures, syndications, right? Buying stuff on your own,
OPM.
Refinances. Yeah,
Exactly.
I mean, there's so many ways to get creative around real estate to scale further so capital doesn't become a constraint.
When you really get into it, and that is the way that most people think about it. Like, hey, I need to have a high income job. I need to have some sort of money, and then I can take that money and go buy real estate. And that's how I can get into the game. But really, the biggest players on the planet, they use other people's money, right? And they find win-win deals for their investors that make sense for their investors to be completely passive, and then they put that money into. So really, there's no shortage of money on planet Earth, right? You can just get better at raising capital and finding deals. It's those two things: raising capital, finding money, and finding the right deals. And if you can do those things really well, you can scale to just astronomical heights, right? Mm-hmm. Billions of dollars. And so that's what we're trying to do here. We're really trying to figure out ways to find the best deals, and we're building out consistent deal flow systems as well as consistent capital raising systems, and those will be topics for other times, but and I'm sure we'll dive deep into each of those. But those are the 5 reasons, just to recap: protect capital, cash flow, appreciation, tax benefits, and scalability.
That's right. Real estate.
Boom. Real estate.
Thank you for listening to the Win and Wealth podcast, where we talked about the 5 reasons to invest in real estate and why we love it. If you got some value out of this, let us know. If not, shoot us a message. Let us know what you want to hear us talk about in the future as well.
And help us out. Share it with your friends, your family, your coworkers. Pound the like button or the subscribe button, and we look forward to keep delivering the goods to you.